Welcome to the Concierge CPA. I'm Jackie Meyer, founder of Tax Plan IQ Software. This is a podcast for accounting firm owners and influencers who are pursuing world-class service. Let's go, y'all. Hey there, I'm Dr. Jackie Meyer, CPA, and welcome to the Concierge CPA podcast. Before we dive in, here's something exciting. Tax Plan IQ users are saving their clients an average of $40,000 in taxes per taxpayer while selling large tax plans. Tax Plan IQ is the ultimate resource for tax advisors. With nearly 500 firms on board, we're helping advisors build skills, grow confidence, and connect with a vibrant community. Want to learn more? Visit taxplaniq.com/podcast for exclusive discounts, resources, and other things mentioned in this episode. Now, let's jump in.
Welcome, everyone. I have a very special guest today, Justin Baker, who happens to be the spouse of one of my favorite vendors at Tax Plan IQ, Jennifer Baker. He is an attorney that has started working with Jennifer at Baker Wealth just over a year ago, and we're going to talk all things estate tax planning. So don't snooze. I know it's not normally our thing. We like to focus on more shorter term return on investment and results in our firms, but there are some really interesting things going on in the estate planning arena. So Justin, welcome. Tell us a bit more about yourself.
Yeah, I appreciate it, Jackie. Certainly glad to be here. Sure, as you mentioned, I am an attorney. I went to law school in Houston, here where we live, at the South Texas College of Law. Graduated from there, and then I did get my LLM in wealth management law from Texas A&M School of Law.
Whoop!
Yeah, that's right, gig 'em. So and prior to that, I earned my MBA while I was on active duty in the Army. So I got an MBA with a concentration in accounting. So hopefully that will relate well with the audience here. I do speak not very fluently, but just beginner level accounting. So
yeah, very cool.
And so, as you mentioned, I came to work at Baker Wealth Strategies for Jennifer about a little over a year ago. And then prior to that, my professional experience as an attorney has been in estate planning, and more specifically in advanced estate planning, navigating through estate tax planning matters, as well as, closely held business interests and business succession planning, closely held entity governance, and those types of matters. So obviously, I understand estate tax may not be the hottest topic for everyone, but I sure enjoy it, and I look forward to talking about it with you today.
For sure. I have to give a shout out to Jennifer because she has been an excellent proponent and advocate for us here at Tax Plan IQ and our users in the defined benefit plan arena, which is another strategy that you sponsor and y'all do very, very well in. But we're also adding in this kind of estate tax component. And so we'll be able to deep dive into that a bit today. So let's start with kind of where we're at in the today's landscape. Tell us about it, Justin.
Yeah, for sure. It's as with, I guess, most things, tax cuts and Job Act wise, it's an interesting time. So in 2025, the current estate tax exemption amount is $13.99 million per individual. Just for the ease of conversation, I rounded up to 14. Let's just call it 14.
Okay.
Per individual, 28 million for a married couple. So obviously that's a pretty significant amount of exemption. And then any amount of taxable estate over that exemption is, again, for ease of conversation, it is a graduated bracket, but it graduates pretty quickly to 40%. So at $1 million, you're at the 40. At $1 million over the exemption amount, you're at 40% tax rate for the taxable estate. So I say that, and as I alluded to, the TCJA, as we all know, is slated to sunset at the end of this year. as we look through it, I mean, I literally just looked it up today in advance of our conversation here, just to make sure that this how quickly it changes. What it was yesterday may not be what it is today.
Right.
So as the extension kind of meanders through Congress, we'll see what's on the chopping block. But if nothing changes, so if Congress does nothing, it will sunset, and the exemption amount will get cut in half. So it would be so it's kind of it's inflation adjusted, so it's hard to say exactly, but probably around $7 million per individual, 14 for a married couple, in starting January 1st, 2026. So people who were well below the $30 million threshold on New Year's Eve may find themselves in a bit of a pickle New Year's Day if they're in that unsweet spot between what it was before and what it is now.
Mm-hmm.
So I think the notable piece on this is it always gets discussed as on January 1st, it's going to be different. It will be, but the first estate tax return for a decedent would not be due until September 1st of 2026. So Congress has all the way up until the end of August if they retroactively apply any extension of the TCJA. But I think it's not terribly controversial to say that I wouldn't put all of my estate tax eggs in the Congress doing something in the
Sure.
11th hour basket. But I just feel like it's worth noting that it's really September 1st of 2026 that the first estate tax return would be due. So there is a little bit of time there after, and it's not unprecedented either. It happened in 2010 with the estate tax
Mm-hmm.
there.
Okay. What percent or amount of taxpayers actually exceed that threshold?
Oh man, I love this. This is one of my favorite ones. So probably around 0.2% of American households pay estate tax. And so you'd say, well, then it doesn't seem like it's that big of a
Wow.
fizz. The thing is, and what you can't
Uh-huh.
count is how many would have paid estate tax had they not engaged in planning in advance of it, right? So because uh, through planning, you can generally, especially at the exemption levels that we have right now, pretty well work down the estate tax exposure for a great many families that would otherwise be subject to estate tax. So the answer is somewhere around 0.2% of American households pay it. It's impossible to say how many would otherwise be exposed to it, but for doing some planning in advance.
Sure. Okay. So as kind of alluded to earlier, a lot of CPAs and accountants tend to focus on income taxes. Why should they really hone in on estate tax planning as well, that longer term picture?
Yeah, I think so. That's a great question, and from the perspective of like, so what's in it for me? Kind of a deal of like, why am I
Yeah.
concerned about this? That sounds like your thing, but here's the deal that I think we all know this first is as allied professionals. There's a lot of bleed over from clients' expectations of like, hey, when you start parsing out, I'm your income tax guy, not your estate tax person or professional. When you find yourself in that conversation, you're probably playing from behind the eight ball, right? So
Hmm.
I think first of all, just to maintain the relationship, but really to further the relationship, to say, hey, you know, I can differentiate the level of service that we provide by making it a more comprehensive analysis. I'm not just implementing an income tax plan for you. I'm helping you identify a risk that you didn't know about. But we could save all the income tax in the world, and if at the end of the story, it's all subject to 40%, or much of it is subject to a 40% tax. Well, then it's kind of like clapping with your gloves on. It's a whole bunch of work for not much result. At the end, you're still paying tax. And so I think that is a key distinction for clients is like they say income tax, and income tax hurts all the time. It hurts every year, right? And estate tax just hurts at
Mhm.
the end, and it hurts your survivors, not the taxpayer individually. Um,
Mhm.
but helping clients kind of see themselves, I think, really does cement that relationship, differentiates between competitors, and then really helps the CPA establish that place as the trusted advisor in that client's ecosystem. And so I think that there's a lot there in doing that, and it makes a relationship. It just makes it stickier, to say, hey, look, here's your income tax plan, and I've put a placeholder in here for you because in reviewing your personal financial statement and reviewing your financial landscape, you either do now or it's reasonably foreseeable that you will have an estate tax issue that should also be addressed. And so that doesn't mean the CPA needs to become an estate tax expert. I'll handle that piece. It's just we work collaboratively to get the client where they need to be on both fronts.
Yeah. So I've had clients that say, "Oh, well, I'll be dead. I'm not going to worry about it." And I find that quite frustrating because one of my purposes in life is to minimize people's tax liability and use the knowledge that we have as power, right? And so, even if they're not around to deal with it, we definitely want to try to make our beneficiaries' lives as easy as possible when they're already dealing with probably the emotional impact of losing that person. So let's say a client dies with an unexpected estate tax bill.
Yeah.
How does that dynamic play out?
Well, I mean, that's funny. Yeah, you're right. There are a lot of facets to the dynamic, right? So there's the practical one of how are we going to pay this bill. But if you think, let's see the way it plays out. The bill arrives, and the surviving spouse, the surviving children, whatever, get the tax bill from the IRS. Now, most people, when they get a tax bill from the IRS, who do they call? They call the CPA, right? I got
Mm-hmm.
to. You sure don't say let's call the estate planning attorney. So then again, you're answering. It's like, why do I have this tax bill? How could this have happened? And then the dynamic in that facet of the dynamic, it plays out again where you're kind of on the defensive. Like, well, hey, look, I didn't get engaged to do estate tax planning. I got engaged to do income tax planning. But that, generally speaking, for the client is a pretty unfulfilling answer, right? Like, okay, well,
Mm-hmm.
uh, you're my tax person, and I've got a huge tax bill from the IRS. So I'm unpersuaded, unmoved by that parsing of what the roles and responsibilities were. I mean, that's just kind of the way it shakes out. But I would
Mm-hmm.
also point out that like for the family, then, like, who should have done, if we got to the bottom of who should have done what, we're still sitting on a significant tax bill, right? And so then how do we pay it?
Yeah.
And I frequently say, and I sincerely believe, that if we'll do the planning to the left of the crisis, then we'll have more options, and there'll be better options. So you could say, like, oh, well, there are options available, the Reagan loan, a 6166, but all of these are limited, kind of put you in business with the IRS, and are not as tax efficient as if we just got to the left of it and did some planning. And so that dynamic can really be difficult if you think in terms of a family business that triggers it, right? Like, the valuation of the family business is what's triggering it. So where do you get the cash to make the payment? And so those are the dynamics at play. And I think ultimately those are all the fiscal dynamics, but I really think that there's that relationship dynamic, that it puts a strain, to your point, during what is presumably an emotionally difficult time. Now we're looking at a financially difficult time,
Mm-hmm.
that compounds that and can really put unnecessary pressures on the surviving family. And
Yeah. From uh, the a few tips here for our listeners from the CPA perspective on things that you said that I really think are important. First of all, my own firm that I sold a few years ago was what we called a concierge CPA firm. They expected us to be the quarterback of all of their financial picture between financial advisor, estate attorney, et cetera. And so it definitely wouldn't have flown, if that's the word, for us to be like, oh, I didn't realize that this was a thing. So actually, there were like 4 or 5 questions I would ask every prospective client before I developed out a proposal and engagement. And one of those 5 questions was, what is your net worth estimated at? And so based on how they responded to that, I could tell whether they were close to or, well over or well under these particular thresholds for the estate tax so that we could start looking into these types of matters. So I would highly recommend that our listeners do the same with their clients. If you haven't asked them before, just go ahead and, add it to your organizer questions this year so that you can figure out if there's a bigger value added engagement. Now, Justin, let's say that someone does get themselves in a bind, or maybe the CPA does go ahead and proactively identify an exposed client. What does mitigation or abatement look like in that process?
Yeah. Okay. So that is, and this is where I do need to put in my disclaimer, right? That while I am an attorney, I'm not your attorney, the listener's attorney. We don't have an attorney-client relationship, and you shouldn't take any maneuvers based off of just this conversation of general topics without speaking to counsel that does represent you. Okay, so that being said, what kind of attorney would I be without my disclaimer? So, really, when you look at it, and again, now I'm really going to sound like an attorney because it depends, right? That's the worst attorney. That's like my go-to. But
Yeah.
I'll tell you what it depends upon, though. To really, there are generally speaking 2 flavors of estate tax exposure. The one I alluded to already is the closely held business interest. So you have whatever type of business, it is valued at an amount that would put you at or over the estate tax exemption amount. So it's kind of an asset heavy, liquidity light scenario. And it's all relative. Liquidity is not terribly strained for paying for day-to-day activities and such, but for paying a hefty estate tax bill, that would be liquidity light. And so the problem set there looks a lot different than the client who has a lot more liquid of a portfolio or asset holding array that triggers the estate tax. So there, the two different problems are going to have 2 different types of solutions. Typically speaking, with the closely held business, and this is a broad explanation, but what we look at is how do we get the business interest out of the owner's taxable estate. It's typically set up through an intentionally defective grantor trust structure with a part gift, part sell of the business interest. Where it gets a little tricky is, it oftentimes involves recapitalizing the LLC, corporation, whatever, partnership, to where we have voting and non-voting, or corporation or LLC, to where we have voting or non-voting interest, so that we can get around the control piece, right, and the economic interest piece. So if we say, hey, look, I don't need all of the economic benefit in my estate. We can transfer a lot of the non-voting interests out to this intentionally defective grantor trust for the benefit of, the kids, grandkids, however we want to set that up, while maintaining the voting interest with the economic benefit going to the, if you structure it with a promissory note type part sell, you can get either with gift as well, you can get your valuation discount for lack of marketability, lack of control. But you can still provide for the business owner's liquidity needs by paying, interest and capital periodic or principal payments periodically on that promissory note held in the grantor's estate. And if we've got a real pickle, we can kind of bundle. We can get creative with how the terms of the note are structured for repayment, so that if as you look at valuing the note payable in the grantor's estate, we can get a reduction on the fair market value should the grantor die prematurely or not live through their actuarial lifetime that we intended to pay the note down over. And then the belt and suspenders approach would also involve oftentimes an ILIT that would provide the liquidity through that death benefit to the decedent grantor's estate. So it gets pretty, that part probably didn't sound all that exciting. And the devil's in the details with these things as well, and I would say, and I'm sure that I imagine you see it frequently, but the IRS is really, really scrutinizing valuations, right? What's the fair market value of, and valuation discounts in particular. So I think when you look at it, if you're going to economize somewhere, I wouldn't do it with this type of planning. Like save money somewhere else. I don't know, clip some coupons, but let's engage a legitimate firm to do the valuation discount that's not in any way related to the parties involved in the transaction. An outside, unrelated, qualified third-party valuation company with experience in that area. And then I think the hard part too with that is the feeding and watering instructions to keep it going are not insignificant. Like the note's got to get treated like a note, right? The interest has to be paid on time in full. Any true up that needs to happen after the valuation comes in needs to be completed. So there are a lot of details there. And then as you look at so that's kind of the closely held business. Did that answer the closely held business aspect before I move on to the?
Yeah, it did. I guess I'd love to do like kind of a quick practical example. So let's say, and I know this is all general estimates, so don't get too in the weeds with the details, but let's say that someone has a business worth or net worth 50 mil and they pass. What tax savings would they actually get from doing the trust structure versus paying the estate tax? So we've got the 50 mil minus, if they're married, maybe the 28 or so mil, right?
Yeah, that's right. Yeah.
And then, so walk me through like what that tax effect is.
Yeah, that's a great. I mean, I think it's a good setup, right? To visualize what if we do nothing, then what, right?
Yeah, exactly.
So, then, so let's just do, and to make the unlimited marital amount go. To take that away, let's do a simultaneous death. That's the second spouse. The estate's valued at the estate is valued at. Let's just do easy enough math, $50 million, right? Is that what you said, 50, 40? What'd you say?
Yep, 50.
Okay, okay, it's called 50. That's good because I can do that kind of math. And so, and it's in, so in this scenario, they have about a $20 million exposure, right? 22 million. So you'd go 40% of that. What is that? $8 million estate tax exposure, right? And so if you did the planning in advance, so that's level setting. You did nothing. You said, hey, I've done pretty well. The kids are going to be just fine. If they can't make it on, 42 million, I can't help them. But we said, okay, but there's another way, right? So let's look at that. And so if we did the planning in that scenario in particular, if you just conservatively estimate that you could take a 30% discount on the assets that you're transferring over on, so let's use up our lifetime gift tax exemption. Let's use that up as a married couple, right? And then let's say, okay, The rest we're going to sell over to the intentionally defective grantor trust. The rest that we want to get out, we're going to sell. We get a 30% discount there. Without drawing it out on the whiteboard, we've gotten rid of our estate tax problem. So this is what I think, and hopefully for the folks listening, the tax professionals, the CPAs listening, that if everybody knows that a tax saved is like a home run, right? And clients really enjoy that. So if you say like, here's where and I can help talk through this if I have the personal financial statement, understand kind of what map out what their exposure is, walk through, and then you can put this in your tax plan. Like, this is the amount that if you died yesterday, I always use yesterday because I'm pretty sure they didn't die yesterday if we're talking to them, absent a weekend and Bernie scenario. And then I don't know what's going to happen tomorrow. So let's say if they had died yesterday, you would save around $8 million in estate tax exposure that otherwise would be due. And so that is a pretty meaningful amount to clients when you say that.
Hey, it's Dr. Jackie. Are you enjoying today's episode? If you are, here's how you can support the podcast. Like, share, and subscribe to the Concierge CPA podcast to help us reach even more listeners. Continue the discussion and connect with other accounting professionals in the Accounting Firm Influencers Facebook group or follow me on LinkedIn. Thanks for listening, and now let's get back to the show.
It is. Yeah, I would definitely say at the end of the day, people just want to know what that bottom line kind of impact is. And so it's important when you start explaining these things to the client that they don't, not to get them lost in the details. Like, what's an islet? I don't get this. I don't know what's happening. It's like, look, we can do some estate planning that would essentially save you probably $8 million estimated. It's going to be complicated. There's going to be multi-step process here. We're going to need to involve an estate attorney. There will be cost. The cost won't be nearly anything close to the 8 million. And so if that seems like it's worth it to you, would you like to proceed? And typically, whenever you put it in that kind of very black and white framework like that, they're like, well, yeah, of course I do. And then you can remind them of that whenever they go through some of the tougher parts of the process, maybe too, right?
That's right. Yeah, for sure. Like that's your motivational, put it on a Post-it note. This is, on the this is $8 million, so, but I also think, and one of the things that I enjoy about this in engaging with clients is kind of converting the estate tax code, the trust, code, take it all down into an understandable level where they can understand what the problem is, broadly what the solution set looks like, and what we need to do in order to make it work. And so, from the Baker Wealth Strategies perspective, I can help design it out. I can help draw out what we need to do. And depending upon what jurisdiction, what state they're in, I can connect them with a lawyer who is able to, I'm able to communicate with. I can walk them through it. I could be on the meetings with the client if they wanted. I'm not going to draft the documents. I'm not the highest and best use of my time, but we'll get them all set up. And also I'm licensed in Texas only, so it would be fairly limiting if it was me doing it. But the federal estate tax is obviously a federal level deal. So I could speak to that without practicing law in other states, and then connect them with local counsel that can walk them all the way through. If they already have an estate planning attorney, I can talk to them. I can review the documents for the clients once they're drafted. Just help them kind of through the whole process. They have somebody on their side who's connected with their CPA, who's connected with their estate planning attorney. And I think it gets to your point of like, hey, look, broadly speaking, here's your exposure. There's some things we can do to reduce it. It's not going to be free. It is going to be a heck of a lot less than, if you don't like the bill, that bill, you're sure not going to like what the IRS sends. That's the
For sure.
One of the idea, I think,
Mm-hmm. And how do you charge for that work so that our listeners kind of know, how does this whole transaction work?
Yeah. So for me, to do the consultation with them, there's no cost to the client for me to do the consultation, do the design, and that is just a part of what Baker Wealth Strategies brings to the table. Now,
Awesome.
um, the you know I think it help, and the idea hopefully is to help kind of extend, cement, um, expand the connection and resource that we can be for the folks in the network. Yeah, so that's kind of the idea there.
Okay, gotcha. And then what kind of cost would someone expect with the closely held business owner you just described and that, trust structure? What kind of general idea of like cost is it to set that up and maintain?
Yeah, so I would say, and I know this is going to be a pretty broad range, but having done it for years, the closely held business scenario that I just described, where we do need the ILET to buy down the estate tax exposure risk that remains until that note is paid down, including the valuation. I would expect the bill to come in at around $25,000 to $50,000
Okay.
for the client, and then
Yeah.
the ongoing, and so that's the bill to get it all set up, right? And then there is going to be a life insurance policy that is going to be in that ILET, so there'll be a premium, an annual premium for that policy. Um, and then other than that, like once they have it set up, there's just some residual expense, but it's fairly minimal in that scenario.
Okay, cool. Yeah, no, that's a good general idea. So now let's kind of shift gears and talk about the clients that do have liquid wealth. So what, like investment portfolios, cash, publicly traded stock? What estate tax planning tools work best for those clients?
So there are a multitude of ways to get there, right? Oftentimes you can structure the family limited partnership, transfer the assets into a family limited partnership
Oh,
structure.
I love family limited partnerships. We did those a lot with attorneys at my own firm. Yeah.
Yeah, and so then once we do that, then we've bundled it into a business, a closely held business, right? And there's a little bit of timing that has to happen there. But the IRS, as much as we both love FLPs, the IRS hates them, right? So they come
Yes.
after them. So there's an equal and offsetting disdain for them on the IRS side of the house. But it is still a legitimate way to do it. It's just that how, as it's always said, bad facts make bad law. Some people have gotten a little overly aggressive, or not a little, just overly aggressive, with some
Sure.
of the valuation discounts, with some of the FLP cases that came through, where you're looking at some deathbed planning that was plainly for only a tax purpose, or where the wealth creator was still the beneficiary of all of the assets. So it was kind of an illusory um, business entity. And so I frequently say, like, hey, look, if you're not going to treat it like a business, I promise you the IRS is more than ready to not treat it like a business. So
Hmm.
but the FLP is still a pretty solid workhorse if you treat it right, and do it as described. Then obviously there are the grats. If for our more charitably inclined folks, the charitable remainder trust, charitable lead trust. Um, so there are opportunities uh, that exist there for our more liquid portfolios. But I would say we're probably depending on the clients, we're going to, as we go through the progression, we're going to look at a family limited partnership structure, or family LLC structure, um, bundle it, and then create our intentionally defective grantor trusts, and try to get from here to there. Again, the GRAP may work. It just kind of depends on what the rest of the client's assets look like outside of what we're transferring. Um,
Hmm.
so there's that there, for sure. And it just made this there is a great planning opportunity for folks who even have these structures in place. for tax planning clients who the CPAs on the podcast are listening, that we could look and make sure that we're still up to date with where we need to be, see if any update needs to happen. I mean, it's, again, a value add, kind of extends that relationship. But in having done that, it's been a couple of years ago now, I had a client who had created a family limited partnership, transferred the assets using lifetime gift tax exemption and promissory note so part gift, part sell on this one, to intentionally defective grantor trust for the couple's adult children. And then unfortunately both the spouses became about to pass away. And so I'm looking at the trust structure, what the assets are in there, what the assets are in the grantor's estate. And if from the tax code, one of the powers that triggers grantor status is the swap power, right? So the ability to exchange assets from the grantor's estate with the assets in the trust, they have to be of equivalent value. So these need to be fairly, in order to do it in a bulletproof manner, they need to be fairly easily valued. For instance, publicly traded stocks would be great. But then you have some in the trust that have a low basis and highly appreciated, right?
Mm-hmm.
But they're not going to get an adjustment in basis at the grantor's death. They're not going to. So because they're in this IDGIT. So if they were in the grantor's estate, though, they would get a basis adjustment at the grantor's death.
Right.
So we were able, through using the swap powers, and you got to be very, very deliberate in the way you transfer these assets, how it's documented, make sure that it is done properly. But we were able to save this client, who was, again, had plenty of cash outside of the trust to pay for everything else, but saving $3.5 million in capital gains tax.
Nice.
Right there. So, that's, I don't care who you are, $3.5 million is going to move the needle on, if you don't have to send that check to the government. Most people are going to be pretty happy with that.
That's awesome.
So anyway, my point with this is, through that, there are opportunities exist to reduce estate tax. And then even for clients who may already have structures in place, there could be an opportunity as well, though, to optimize it, to fine tune it, and make sure that we're not leaving things on the table.
Mm-hmm.
I would hope
gotcha.
a CPA that, you can say, like, hey, look, we're keeping a scoreboard of how I'm doing. Let's put $3.5 million on the scoreboard. Is what I would
Exactly. Think. Yeah. And use the return on investment, the ROI method of value pricing, which is our calculator in Tax Plan IQ, because you can easily show your value by quarterbacking that situation. And of course, you can reflect the third-party fees from the attorneys as well. So it's definitely win-win, really easy scenarios there. Okay, so any other kind of popular estate planning strategies out there today, or do you feel like that you've really kind of encompassed all the good ones that people should know about?
Yeah, so there are a couple, that for generational planning. So you can plan. So say, for instance, you have clients who are successful. They have an estate tax problem, but they didn't come from a long line of money. They're the first generation, right? Well, there's still some opportunity there to use the older generation's estate tax exemption as well. They're not going to need it. God love them. They didn't get there, right?
Mm-hmm.
And it's through beneficiary deemed owner trusts. So in this way, it's a super complicated structure. This is not, LegalZoom's not going to get you there, but in identifying that, where you say, hey, look, we've done what we can do here. How can we move up and use up the older generation's unused? And so it's a pretty complicated structure, but the B dot and the B jet are pretty popular for closely held business owners for the B jet. BDOT for those who have wealth outside of a closely held business. So those are pretty good as well. So I think the important thing is, like, there are so many tools in the toolbox to help clients buy down estate tax risk that it would be just a shame to leave that on the table for the value that firms can bring to clients.
Mm-hmm. Okay. That totally makes sense. So, as we kind of work towards wrapping up here today, a lot of really good information, but um, how do you suggest that a CPA or accountant kind of begin this conversation with their clients if they haven't talked about estate planning before with them?
Yeah. So, I mean, I think that there are a few, like, if you are, if doing an annual review of, hey, look, here's the state of play. This can be a placeholder, like in the tax plan that you're putting together, of like, hey, look, we've got to talk, and here's our resource of who we connect you with on it, is a great way to do it. So whatever, if it's, year-end planning, if you're doing annual gifting, if we're not taking advantage of annual gifting, I think we're leaving money on the table there as well.
Yeah, I was going to throw that out there as well, just in case people aren't aware of it.
Yeah, I mean, a married couple can give, $38K in 2025 tax-free to whoever, right? And so there are a lot of opportunities that exist there if you have a taxable estate issue. I mean, it's out there. So when you're talking about year-end planning, or if there's year-end moves that they need to make in order to reduce their income, they're not a bad time there for sure. And then I think too, for new clients coming in, like, it's just part of the deal. Like, we're doing a holistic look here. You're not taking on the role of providing estate tax planning, estate tax advice. You're taking on the role of saying, hey, look, I think we have something to look at here based off of your financials. And also, I would tell you that if you have a young couple or a young client who is rapidly appreciating in value, it's probably, sooner beats later on, like, I don't have an estate tax problem now, but I may coming up. Let's talk about it. Let's see how we can best position. Like I said, the further to the left of the tax we can get, the more options we have, the better the options are. So really that year-end review, whenever you do the annual review, and when you're creating the initial tax plan, I mean, those are just great opportunities. But I don't think there's ever a bad time to reach out. I mean, it's a non-sales call. You're not calling to say, like, hey, look, would you like to buy this? I mean, you're saying, hey, look, I've been we're doing our routine periodic reviews of client files. It looks like that you may have an estate tax exposure either presently or as a result of the TCJA. The TCJA expiring, as it's set to expire at the end of this year. If you're going to do a lot of this planning, now's the time. I mean, I don't wait until after Thanksgiving to get started. It just doesn't happen that fast. So there's an option there to say, like, hey, look, I think it's worth a talk, because we don't know that the Tax Cuts and Job Act will get extended. We don't know that a concession that has to be made in order to get the income tax provisions extended won't include a chop at the estate tax.
For sure.
And if you'll remember back to when former President Biden was elected and he had his tax proposal, I mean, everything about estate planning was on the chopping block. All of the workforces, grantor trusts, the exemption amount. I mean, just about everything was on the chopping block. So I would say that as we look at this right now, what we do know is that until 12/31 of this year, we have historically high exemption amounts.
Mm-hmm. Okay, that totally makes sense. And by the way, listeners, there are immediate income tax savings that you can get your clients from enacting some of these longer term plans. An FLP, if you start gifting interest to your kids, for example, maybe they're grown adults, and then sell a stock, you might be able to recognize that in a 0% cap gains rate instead of a 20% cap gains rate. So there's there are more immediate benefits that you can massage and whatnot legally, as well as that bigger and longer term estate planning benefit. So that's what's kind of the fun part for me, is like, it's not just something that will impact you when you pass, but there are things that we can immediately impact today with you and your family too. So, yeah. On that note, Justin, I really appreciate your time today. Really appreciate Baker Wealth and what all y'all bring to the table for your clients. It's really a concierge type service that is hard to find. What is one piece of advice that you would maybe kind of end our podcast session with today to our listeners?
So I think the piece of advice I would give is I absolutely recommend that you start the conversation about this before the client starts the conversation about it, right? I mean, that's just, getting in front of it is a lot better than answering like, oh, well, yeah, you probably do have, an exposure. So I think just you start the conversation before the client starts the conversation. And I promise, like, I will collaborate with the CPA. I will make sure that the client is well taken care of, and it's the best possible advice I can.
Yeah. Awesome. That's really, really good advice for sure. So for our Tax Plan IQ users, we've got Justin, Jennifer, and Baker's Wealth contact information in the tax planning strategies in our library. For those that may not be users yet of Tax Plan IQ, what's the best way for people to get a hold of you?
Well, you can go to the Baker Wealth Strategies website, bakerwealthstrategies.com. My email address is justin@bakerwealthstrategies.com. So either one of those works. And certainly would look forward to speaking with anybody. I love talking estate tax, so an estate plan.
I can tell, and you smile about it too, which is nice.
So I'm happy to talk to anybody about it.
Awesome. Okay, cool. So we only have a couple minutes left, but I'm going to do 3 rapid fire questions because I'm just curious about how things work over there. You made it clear before we started this podcast that when you came to work with Jennifer, she made it clear you're working for Jennifer. So quickly tell me, like, what comes to mind? What is it like working for your wife?
You know what? And it's not just because I know she's going to hear this or she may be listening. It's because, I mean, it's not also because of that, but I'm just saying it's not solely. No, I'd really just respect her tremendously as a professional. I mean, I think it makes it very, very easy. She's done a great job prior to me being here, on board with Baker Wealth Strategies. So, it's been a really smooth transition. And it just feels, pretty natural to when you work for somebody who you respect, and who is an absolute expert in the field. Makes it pretty easy.
That's awesome. Okay. And I know y'all have kiddos. How old are the kiddos, and what's your favorite family activity?
Okay. So we have 2 boys, 8 and 13. Historically, we have a pool. It's Houston. You got to have a pool because it's
yeah.
So swimming with the kids is great. Absolutely. But we just got the backyard turfed, and, we have a pretty good sized backyard. So it is now, we got a putting green put in. So we kind of converted part of the yard into a par 3 hole. So it's golfing. We did that last night for, I don't know, like an hour and a half. So the whole family out there just hacking away, trying to get it done. So
that's so fun. I love that. Okay. And last question. I grew up in College Station. I went to A&M my freshman year, and then I had to hightail out of there to Dallas, Fort Worth, because I was working full time. I had done all the bad college things when I was way too young in high school. So did you do all the traditional things when you were at A&M, dunking the ring and all the things?
No, because I got my LLM, right? So like I'm, older, but
okay.
Jennifer is an Aggie. All of our friends out here are Aggies, so we did.
You only hang out with Aggies. So I'm just kidding.
No, I mean, just the way it shakes out. But again, we're like an hour and 15 minutes from College Station. So, it's a pretty good concentration of Aggies out here. But I did do the ring dunk for sure. And then I found out
Awesome.
another age that the ring dunk isn't quite as a good idea as it may have been as an undergraduate.
I can understand that. Okay, awesome. Justin, thank you for putting up with some of my silly questions, but really appreciate your time today. I think this was really, hopefully very insightful for our listeners to grab a whole new kind of value add proposition that they can bring to the table for their clients just by being that quarterback or any intermediary. And they can always reach out to you to help. So really appreciate your time and hope everyone has a wonderful rest of their day.
Thank you, Jackie.
Take care.
Goodbye.
I appreciate you listening all the way to the end. It truly means a lot. As a thank you, I'd love to give you a free gift, my value pricing calculator and proposal workbook. This tool has helped tax advisors create 8-figure tax plans and save over $1 billion for their clients. You can now download it at taxplaniq.com/ROI-method. Thank you for being part of this journey, and I'll see you next time on the Concierge CPA podcast. Take care, y'all. Thank you for listening to the Concierge CPA, hosted by Tax Plan IQ. We believe that every person has a unique message that can positively impact the world. If you are a successful accounting firm owner or influencer who would like to be on this program, please visit JackieMeyerCPA.com, JackieMeyerCPA.com to apply. Please share this on social media and rate us so we can continue our good work. Join our Facebook group called Accounting Firm Influencers, or connect with me on most platforms under Jackie Meyer CPA. Thanks for being accountable to transforming our industry today.